Hey everyone, it's Joey Milam at Alpha Mortgage Advantage, and I want to talk about self-employed borrowers and taxes, tax returns specifically today. I think it's important to know that the advice that you may be getting from your CPA or your tax accountant is likely that to reduce your tax liability, of course. Of course, everyone wants to pay as little in taxes as possible. It's really good to know that while certainly no one wants to pay a lot of money in taxes, when you're writing off a lot of things, expenses and things like that in deductions, it does reduce your accountable income when it comes time to get a mortgage. There are a few exceptions to that. Writing off mileage on a car, depreciation of assets, or home office expense are things that do not count against you. Write those off as much as you possibly can. Other items like meal and entertainment expenses, for instance, actually count doubly against you because you can only write off 50% of those items. So just know that when you're going to file your taxes, whether you're a sole proprietor or an S Corp, LLC, whatever the case may be, when you're writing things off, it will reduce how much income we can show when it comes time to get a mortgage. Just as an example, I frequently will have clients that will say, oh, I made $100,000 last year. Great, but when I look at their tax returns, they show $100,000 gross income, and then they've written off maybe $50,000 in expenses and sales and things like that, so they're left over with maybe only $50,000 in income, and that can hugely affect your buying power. Now, I will say there are some exceptions to this rule. That is with a standard traditional mortgage. There are some other options out there. We have a bank statement loan where instead of using tax returns, we actually use a client's 12 months of bank statements to show what their income is. Now, these are non-traditional, non-QM, as we call them, mortgages. So typically you're going to need more money down. The interest rate's going to be higher. It's really not generally the first loan option choice that we would pick for someone, but it is an option for those that need it. Again, I think certainly reducing your tax liability is always a good thing, but I think it's just very important to know and realize that there are some consequences of that if you're going to buy a home. Certainly, early in the year, I frequently have many clients call me up and ask and maybe want some help and advice on how they should structure things for the coming year so that they can afford to buy a particular house, or maybe they have a range they want to buy in. So always happy to answer any questions you may have about tax implications with regards to a mortgage, things like that. If you ever do have any questions, feel free, 910-250-8888. I love talking taxes with people. I'm a bit of a nerd when it comes to that, and happy to help however I can. Hope everyone has a great day.